I think we should start, because today we're nearly at the end of the day, which, as always, the most exciting topic has been saved to the last. And only those that have really got the energy to keep going are getting to view this exciting conversation. So my name is Ruth Beddoes, and I run Global Capital, which incorporates the cover. And I used to run this conference, so it is very dear to my heart. I'm going to ask my speakers to introduce themselves. And then if anyone has any questions throughout the discussion, please feel free to put your hand up and a microphone will be brought to you. And do feel free to chip in. Morten?
Yeah. My name is Morten Beckmann. I run the investor relations department in Nykredit in Copenhagen. So we primarily, or almost exclusively do covered bonds. I also have the pleasure of serving as a representative of all the Danish issuers on ECBC's steering committee. And last but not least, I chair the technical issues working group under the ECBC.
I'm Luca Bertolot. I have the pleasure to run the ECBC Dream Team in Brussels, and considering the success of the day, we can say it.
Luciano Chiarelli. I'm head of group secure funding in UniCredit. I follow all secure funding, cover bond, ABS, and credit claims to use directly with the ECB. We have a focus in particular on the Italian asset, but also we have a coordination on Germany, Austria, and the CE countries. We are part of a group, the specific working group on the ASN in the ECBC.
My name is Federica Fabrizi. I work for Fitch. I'm part of the cover bonds team, and I'm responsible for rating the cover bond programs issued out of Italy, Portugal, Greece, and Cyprus.
Hi, good evening all. My name is Agustin Martin. I'm running the European Credit Research team of BBVA. I'm based in London. I mostly deal with cover bonds, public sector, and lately with all the green research issues.
Thank you. So obviously ESNs is new to this conference as a topic, and hopefully or possibly will be in the covered bond family for a long time, or at least its cousin. And so Federica is going to kick us off with giving us some insights into how the structures could be rated and what the underlying assets could be assessed. Federica.
Thank you. So maybe the first thing to say about the European secured notes as a new product which is being introduced hopefully to the market is whether they're going to be rateable or not. And the answer to this question is yes, they are rateable. And I would also say that they could be rated at least at the rating of the issuing institution. Why is that? As they are being presented, the European secured notes are meant to be dual recourse instrument. So according to our methodology and how we approach these instruments, from our perspective, these are going to be very similar to a traditional cover bond structure, as long as certain conditions are satisfied. For example, okay, it has to be dual recourse. The issuer, we will have to see an active role of the issuer who will dynamically manage assets and liabilities. The structure of the debt, we'll have to see pari passu cover bonds as opposed to some tranching that we are used to seeing in securitization transactions. So if all these conditions are met and if the instruments in its nature is very similar to cover bond structure, then we would apply the same methodology as we are currently applying for analyzing traditional cover bonds. There are some challenges that I think we should bear in mind when we talk about the European secured notes as a new product, also from a rating analysis perspective. Those challenges are, for example, the asset performance. So how we would assess the assets, including in the cover pool, securing these instruments. I think the aspect of the assets is actually one of the main differences that we see compared to the traditional cover bonds we're used to see in the market. If we think about, for example, SME portfolios, then that could include a very broad range of assets. So now we are used to talk about secured SME assets, which are already included in a vast majority of covered bond programs. But there is a big piece of work that we're missing with that definition that can comprise pretty much everything. And in that case, we would expect to see heterogeneous portfolios, very different from one country to another, but also within the same country from one lender to another. And in that case, what we would do, we would look at those assets by setting country-specific assumptions as we do for SME portfolios that we already rate in securitization transactions, for example. We have country benchmarks for 7 countries at the moment. And what we do, we start from that country benchmark. We do apply the bank benchmark, and we use internal ratings of the lenders as well as internal performance data to calibrate our assumptions. In terms of structure, as I was saying, there's no difference with covered bonds. It will really matter if the structure that will be picked, it will be a soft bullet, hard bullet, or conditional posted structure that will make a big difference from a refinancing risk perspective. Because now what we see residential mortgages portfolio with very long maturities, which are not naturally matched with the liability side. That poses an issue of refinancing those portfolios. If we think about SME portfolios, those are much shorter in maturity and duration, so that may create less, that may be less of an issue in terms of refinancing, but then on the other side, you may have the cost of negative carry on the excess cash that you're keeping in accounts until you need to make the payments on the covered bonds. Another important point to keep in mind is the level of over-collateralization. The over-collateralization level with these types of assets is, I expect this to be higher than what we see with traditional covered bonds. The reason for that is that the credit risk associated to the type of assets that we're currently talking about, which are different from the one that are currently eligible for traditional covered bonds, are meant to be riskier, with the worst performance, probably less performance data, so shorter history than other mature markets like residential mortgage markets. And that creates, let's say, that would give an additional buffer in terms of OC, because we need to capture what is embedded in the credit risk of the cover pool. So if we were to compare for example, the level of credit enhancement on average of SME transactions, securitization transactions that we rate, what we see is for the most senior classes of notes, we see level of credit enhancement on average above 30%. Actually, the range is quite wide, but if we were to set a number, there was above 30%, which compares with a 10% OC level for AAA rated covered bonds, like traditional covered bonds, so secured by residential mortgages and public sector loans. It's a big difference. And that is mainly driven by the asset types, although it also takes into account, as I said, maturity mismatches and interest rate mismatches when those are relevant. And again, if a minimum regulatory OC level was to set, then what we have observed is that normally a regulatory level are not sufficient to withstand a high level of stresses, especially if we were to go up the rating scale. In terms of OC maintenance, that's another point, because we can talk about very high level of OC, but then we will need to see whether that can be maintained by the issuer. So we will look at origination volumes, we will look at the business model of the issuer and the originating bank to see whether they will be able to maintain the level, whether they will be able to originate new assets that are going to be eligible for these instruments, which to me is still not clear how they will become eligible or not eligible. So these are the main things. Then I can.
Seems like a lot of challenges.
Yeah. Some comment, because I take to some point of your discussion about the OC, the credit enhancement, the regulatory OC. In particular, on the issuer point of view, as you said before, is normally we use the SMEs for the securitization, And we think is the market, pre-crisis, and also the rating agencies is very more familiar with this pool, also from Italian asset, not only on the other jurisdiction. You speak before about the difference between credit enhancement from residential and SMEs. Normally, because it's a different asset, as the PD and maybe the LGD is completely different respect to the residential mortgages. Just to be clear, we consider the credit enhancement as the OC is not comparable because it's the reciprocity of the credit enhancement, and then maybe 30% of the credit enhancement in the securitization is equal around, I don't know, 10-12% in terms of the over-collateralization. Then it's a very important point because, as you said before, there is some feedback and some final report from the EBA, and then suggest it's very not acceptable on the issuer side, the 30% of the regulatory credit enhancement. In this case, it's normally maybe is higher than the overcall regulated by the rating agency respect of the residential mortgage, for example. Yeah. And then finally, another comment about the different approach of the securitization and the cover bond, the SMEs cover bond on the issuer perspective. In our point of view, normally when we approach all the different instruments, we consider the all-in cost of this instrument, not only the spread, the final spread from the market, but the all-in cost for the issuance means not the operative internal cost in order to manage the one instrument respect to the other one, and also the all correlated cost in order, for example, for the securitization to put several transactions, one for each year, but with the cover bond is a dynamic portfolio, and then when we put in place the program, we can manage better than different securitization.
Yep.
Just one point.
Morten, from the Danish point of view?
Well, I think the first thing to note in Denmark is that, as you all know, the covered bond plays an enormous role for funding the banking system. About 2/3 of all lending in Denmark is already funded by covered bonds. So if you look into the deposit-taking bank's balance sheet, they have virtually no mortgages on their balance sheet. They have a little bit of second mortgages, but still. Therefore, from the Danish banking sector, the feedback has primarily been that they don't really see a huge need for this instrument. They don't have a big desire to further, how should I say, encumber their balance sheet or ring-fence assets. Obviously, you never know what you're going to need in the future, and I agree with what was being said yesterday at the plenary, that it might be a good instrument to have in place. You never know when you're going to need it. But for the time being, I think most of the Danish, or all of the Danish banks actually have the view that we're pretty much in a situation where we find it difficult to see the need. But I can definitely see needs in other places, and I think it's conceptually, I think it's a good idea.
And Luca, from the sort of pan-European perspective, what are you hearing about the need for them?
Well, I mean, for sure, I mean, we don't need this instrument today. I mean, it's pretty clear, and banks issues, they don't need it, and for sure investors, they don't see the need of the instrument. Our job in Brussels is a bit different. We have to see and try to imaginate the market 5, maybe 10 years ahead. We have to look the ESN project very much linked to the directive of a recovery bond, which I still believe is a very useful exercise. Cover bonds were created under the regulatory framework in Europe with the UCITS directive in '88. And we never had any mentioning about asset class till 2005 when we had the CRD. The cover bond framework was a dual recourse instrument, and then there was no reference to the characteristic of the asset. I think that the characteristic of the asset now is an essential component of the cover bond. So it will be a big mistake to put cash flow models in a covered bond concept. The directive, I think, wants to replace the usage box. That's, I think, the purpose. So especially consider the capital markets union, we need to have something that will allow to keep the covered bond clean, poor, don't confuse investors, and tell the covered bond is not whatever kind of asset class, but is a very specific set of assets. I think this is the primary need that we have today, I will say, and in the next 10 days, before that we close the amendments with the directive. And then I think it's I think very wise to open the door to an instrument which will complete the portfolio, the funding option of an issuer and an investors. Because, I mean, we never know what can arrive or how the next crisis will hit one of the European markets, and we have to give ammunition to investors and issuers to be ready to take action. So having something in between a covered bond spread and a securitization spread, I think is only a wise option. I don't see why not to have this instrument. And nowadays, there is a big advantage that will clean the covered bond concept is exactly what we need now. We cannot put something which is unclear for investors. And I think there is a role for a European institution like the European Banking Authority to define what is this ESN in the coming years. I think it's difficult to, people are speaking about spreads, about over-collateralization, but if we don't define exactly what this will be, it's very difficult to give a magic number. So I think there is a work that has to be done from the European institutions to analyze, to give an impact assessment, and assess, maybe a country needs an SME, another country needs maybe an infrastructure loans, so these are discussions that should be kept at the European level. But I think that all in all, we cannot afford not to tackle this issue. There is a huge opportunity cost of not taking action.
And do you think that ABA's, the directive, that says that it should be less over-collateralization for a cover pool and more for an ESN, do you think that's the split is correct?
Well, I think that over-collateralization simply should capture the riskiness of the assets, and most probably ESN should be, should contain assets more risky than mortgages, for sure. And so I will agree that this is, now, I'm not sure that the 30% proposed by EBA is the right level. I mean, and then it depends also for maybe country by country is different. If we put prime SME, it's a different thing as if we put other kind of assets. So I think that we are still far away from defining what is the right range, but I will say yes. I mean, in theory, if there is more risk, you should pay more OC.
I want to comment on the Morten words about the different completely situation in Italy, because in Italy the mortgage market is not very bigger than for example, the SMEs market. And then we have space in order to finance the SMEs. A very important point also on the medium term, because also in Italy at this moment there is a lot of liquidity and a lot of banks is focused on the capital instrument and not on the very standard debt instrument. But we consider this option is a very good option also in the medium-term loan. In medium-term, also we consider the possible replacement for not the target LTRO, because we expect it to finish and then we don't have a new target LTRO from the ECB, but the ECB normally use the other line to refinance the bank. And then normally the Italian bank and also the French bank use a lot of the SMEs credit claims in order to give the collateral to the ECB. And then this option before to go to the market, wise can consider in the bridge period another instrument in order to substitute the credit claims with another ECB eligible instrument.
I mean, I think it's very important to highlight what Luca has mentioned before. What could be the market in 5-10 years' time? And I can give you some insights of what happened in the Spanish market 5-10 years ago, because I think that we can extract from some lessons from there. I mean, it is true that nowadays there is a flood of liquidity in all banks. This instrument is not needed right now. But as it was discussed yesterday in the European Economic Council, initially it seems that this instrument could be more suitable for those countries or newcomers where there is a much bigger SMEs market than residential mortgage market. Some Central Eastern European countries, Turkey, for example, where there is the only functioning SMEs covered market right now. But on the other hand, we saw in Spain how, I'm talking about 2011 figures. In 2011, we had in Spain 450 billion of outstanding covered bonds, including public and retail. If you look at the over-collateralization level of Spanish issuers at that time, it was, most of them, 25.01 to 25.3, which is exactly the legal minimum. It is true that in Spain we have to deal with a much higher OC level than other jurisdictions. But I mean, we exhausted the capability to issue or retain covered bonds, and that happened. And although, if you look at the Spanish issuers right now, and you can see that they have a very significant leeway to issue traditional covered bonds, and they will continue issuing traditional covered bonds as long as they have the capacity. We learned from the past that that capacity can exhaust very quickly, particularly when covered bonds become your only access to market and when you need to increase your second line defenses to go to ECBC. So in Spain, if the legal framework would have allowed us to have a lower OC from 25 to 10 or other funding instruments, we would have used them at that point. The inability to have other funding instruments forced a much stronger, sharp, and socially difficult to explain deleveraging of banks' balance sheets. And that happened in Spain. So a massive amount of SMEs, millions, were disappear in a matter of a few years. So it doesn't mean that the ESNs are going to solve all these issues, of course. But as Luca mentioned, why not? I mean, we have to think in the market in 5-10 years' time, and I think it's well established within the covered bond community that ESNs is a different instrument than covered bonds. It should have different regulatory treatment. We should very clearly define what we are talking about. But this situation where issuers lose their capacity to issue or retain more traditional residential mortgage covered bonds happen already in a big market like Spain. So this is the reason why 5-10 years' time, that could be the situation we have now. Most European banks, I can talk from Spanish banks, residential mortgage outstanding volumes are declining. Most of banks in Europe are now focused on unsecured consumer lending, SME loans, because of margin perspective. So in 5-10 years' time, the scenario that Lucas sees, in significant number of countries, and it will be the case in Spain, the volume of residential mortgages will be lower than now. But we will have higher quantity of other collateral, particularly SME loans collateral. We will have to define what is a prime SME loan. We will have to define the eligibility criteria. But again, my call here is that there could be a case that in 5-10 years' time, don't take for granted that your capacity to issue traditional covered bonds is unlimited, because it is not. And that happened in Spain not so long ago, and it brought difficult consequences and a harsher course of action by banks that maybe could have been slowed down or tempered in some way if we would have alternative funding instruments.
Well, just to step back and having a kind of what is the political role of this instrument in the European Union? We have to compete at the global level. And I think it's fair that every single country, and the country that I'm referring to is Europe, has to put a special capital markets instrument, which is cheap funding for strategic assets. I think every single country has done so. Just to pick up an example, Germany with aircraft fund briefer, or our Danish friends with the ships sector, because they were a strategic sector for their economy, and they wanted to give a cheap funding source for the banks in order to finance there, and not using public money for that sectors. That is a very basic the result. So I don't see why we should not reuse this dual recourse instrument for strategic sector of the economy that are not necessarily the same in the Union. And SME is one of those, which are playing, I think, 95% of the jobs in Italy are created via an SME. So if we don't help the capital markets to provide a very secure instrument, well, someone else has to help it. And it's taxpayer money. And I think that we should think as a union where we have to allocate our resources where it is needed. I'm the first one to defend till the death the covered bond market and the covered bond brand. We have to defend it, and we have to close, I would say, the heterogeneity in that world. At the same time, we should compete at international global level. Our SME, they have to grow in Spain and Italy. The problem is that the SME are too small. If they are not bankable because they don't have this culture. So an instrument like this can bring the SME world to a more bankable atmosphere and can compete at the global level. That's what we want. It's not the spread for the investors. We want to compete at the global level. And that's, I think, an instrument that can serve this political target of the European Union. I'm old-fashioned. I still believe in the European Union.
I completely agree with Luca said before about the value chain in order to have the transmission of the benefits from the bank to the real economy, because also we have the same approach for the residential mortgages. We create, for example, UniCredit and other issuers is the same approach, take the specific spread curve to apply at the origination of the new mortgages, and then we are competitive on the cost of funding. We can also transfer part of these benefits directly to the borrower. And also another important point, also maybe Luca already underlined, is normally the history show when we speak about the eligibility criteria and to define the very clear and soundness asset, there is the impact from the funding side, because if we have finally to try to collect the funding at cheaper cost, also to impact in order to define, to hide the quality of the asset in order to reach these collateral, these eligibility criteria. It's the same approach also in the bank on the residential mortgages, because the residential mortgages, in order to create very clear pool with all data, all information, in order to give the transparency also to the investor, we work a lot in order to collect better the information at the origination side, and then we have very clear and defined very high standard of the asset. And then is maybe the same approach we can follow on the SMEs, why not?
Do you think then that SMEs should include infrastructure projects as well, which has been one of the debates within that pool itself?
Well, that was the original idea, simply because well, we have to define what kind of infrastructure. Yeah. In our task force, we were seeing something which is eligible for a dynamic cover pool. Yeah. So the bridge of Messina is not eligible for that kind of cover pool. But I mean, small works which are very important for our every single country, like, for example, hospital works or streets or little school works, these kind of little things which are very standardizable, could be be eligible for those kind of active. Now, I'm not sure that we could put this in the same box of the SME.
Different type.
So and honestly, maybe also the regulatory treatment can be a bit different. Yes. I mean, we are closer to a securitization need. I mean, we discussed this also in length. This is our feeling. Now, closing the door, I think we should not. I think that there is the need to analyze very in details what are the needs for banks and for the investors, but I think that is an option. We have to be also realistic. In the European Union, banks are not very active in financing infrastructure. There is a need of reviewing the entire infrastructure strategy of the European Union. Again, either we use money, public money, or we allow banks to play a more important role in this. I don't think it is up to this industry. We are ready to intervene. We are proposing something on the table. Then the strategy has to be decided by someone else. But I mean, this is an idea to finance an important sector of our economy. I think the German banks have an interest on this kind of product. That was our feeling. So.
And do you think then that the structure itself will step into the, sort of the old securitization world and step on their toes too much, as we were speaking about in the pre-panel?
Yeah, as I said, I think those kind of structures that we have analyzed are closer to kind of securitization structure. So.
Augustin, you were talking
or infrastructure.
For the infrastructure?
No, the structure themselves, the ESN structure was going into the securitization world with some pushback. Was the
well, if you see an on-balance structure, like the one that we have seen and presented in EBA, I think that is very much a covered bond infrastructure. It's a covered bond technique applied to a different kind of collateral. So it's the technique used, but I mean, it's producing, I think, a different instrument.
Yeah.
Which is the ESN.
Finally, maybe the securitization we can apply is if the target of the issuer is to release the capital, is not for the funding purposes. And then it's maybe better to use the securitization and not the covered bond. Yeah.
I mean, it is true that for SMEs, or ESN SMEs, I don't know the reason, but since the very beginning, I have been participating in some of these debates. There has been a discussion about if covered bonds or STS, SMEs, ABS should be the right tool to channel funding of SMEs. I think that both instruments should have their space, as they had with mortgage covered bonds and mortgage RMBS in the past. I mean, ESN SME shouldn't be seen as the last nail in the coffin of European securitizations. I mean, the problems of European securitizations did not begin with ESNs. They began later and earlier and for different reasons. But having said that, if we look even at the glory days of securitizations in Europe, SME ABS was already a very small market. It was just active in Spain and Italy to some extent. So it was very, very small market, even in the glory days before the financial crisis. And even in Spain, to have a functioning SME ABS market, there were necessary guarantees by the state of some regions in the senior tranches of these securitizations to work. So we are not talking about hundreds of volumes asset class in the past that now, because of regulation, it has completely disappeared. I do really have the view that Europe needs both securitizations and ESNs. But having said that, we have to be very honest. The investor base in Europe is used to dual recourse instruments. The European investor base in securitizations has been mostly dismantled, apart from in very specific niche asset classes. And that's the reality we have. We can like or we can dislike it, but this is the reality we have now in Europe. So I honestly believe that I honestly desire all the success for STS securitizations, but for example, Luciano will have to comply with the 102 criteria to fulfill the STS securitization. So good luck if he fails in any of these 102. Penalties are so big that, I mean, you need to be brave to be in a financial direction now and issue a supposed level STS securitization from next year. So we cannot really wait for the securitization market to be back in Europe. Hopefully it will be back, but it will take many, many years because it has been dismantled. There has been no proper functioning market apart from the UK, the Netherlands, and some very niche asset classes. We don't have such a market. So we need to fill the space. And ESNs can really, as I explained before, and that would be the most important part of my message, don't take the capacity to issue mortgage cover bonds as unlimited. The capacity can exhaust quickly, and then banks are forced to make nasty decisions. And when they have to deliver the balance sheet, and they have to think, should I cut lending on residential mortgages or on SMEs? Believe me that SMEs are the first to suffer, because residential mortgages, you are in the TV news, evictions, foreclosures, but the pure small SME in Spain or Italy, who really cares about that? And that happened, unfortunately.
I think I'm very much in line with Augustine on some of these views. I also think that there could also be SME loans that are, how should I say, uneconomic, to do a true securitization, in the sense that you need a certain spread. There's some cumbersome thing to do, true sale and all that kind of thing. So a covered bonds-like structure like ESN would probably in some respects make it more economical for banks to go down that route. Obviously, I can see the securitization industry say, wait a minute, this will force some competition on us. But on the other hand, they would probably not be eligible for their transactions anyway.
Yeah.
So this would actually open a route for banks to have funding or create an instrument that can be used for repo financing or whatever. So I think there's not necessarily a big conflict the way I see it between the ESN and the STS.
I think that also at the global level, it's an important initiative, because when we go in different countries, we speak with issuers, and they have crazy ideas on how covered bonds can be implemented. I would say in the US, for example, I mean, I had meetings where they were preparing credit cards covered bonds, and I mean, this is not a covered bond. So having a box where you say, listen, this is not a covered bond, and this is something else, is facilitating to keep the global spectrum, I would say, clean. And when we were in Singapore with our Asian friends, it's really, really simplifying meetings where you say, listen, this is not a covered bond because you are not using mortgages, which is a very standardizable product. It's something different. And this has a different name, which is a European secured notes. It's not this. So it's really helping to defend the covered bond brand at a global level in the Basel discussions, because at the end of the day, that's it. This is the game. And I would like to recall, because I mean, yesterday I think that we have also had the position of several investors in the panel, but the spread, again, is the result of several factors. If you're not important for a country, you don't get the privilege and the preferential treatment. If you don't get the preferential treatment, you don't get a nice spread. It's ABC. And I understand that, I mean, the spread is an important component, but it's a result of a long story. And our job is to build the story and to tell that an asset class is important for the real economy. Because we need to explain how we help borrow to get a cheaper financing line. It's true for a borrower for a mortgage, but also for someone that needs an SME loan. So that's why we have to build a very convincing story and a solid story from A to Z. Mm-hmm. And that's what we are trying to do.
Given Turkey is the only country with established legislation around an ESN-style structure, do you think it's actually easier to establish that before a cover, given that we are so covered bond-centric and we understand what that structure is and it's part of our DNA, I think it's easier to establish something new in a market where covered bonds are not already established, if that makes sense?
Yeah, I mean, Turkey has been developed because there is this need. Yeah. And we follow in the covered bond box, which was a mistake for us. We were maybe not covering Turkey properly at that time. But I mean, I think it's a precedent that, I mean, should be avoided. Mm-hmm. I mean, I have to say thank you for the Italians that they accepted to wait for a European solution before following the other things. We had seen Commerzbank that has produced this, which was a different animal. We all perceive it as a different animal, and I think it's, as a European perspective, we need to create the box and make everyone comfortable: issuers, investors, and regulators. And yeah, the Turkish example for
Rating agencies.
Yes.
rating agency, rating agency as well. Actually, you make us comfortable. I mean, but I mean, and Turkey, yes, but I mean, it's confusing. And of course, we need to improve the clarity for investors. I think that's very important. Maybe we have to do a label for ESN like we have done for the covered bond label. We are ready to use something which is on the same kind of thing, which will make a clear demarcation line between the two different dual recourse.
Yes.
One covered bond and one ESN.
Which would make the rating agency's job easier as well.
Well, it is a different animal, and when Luca mentioned also the structure program from Commerzbank and also the Turkish law and everything, I mean, while he was speaking, I was thinking, so why don't issuers just use structured programs? Because it did go well. I mean, it's not like, it was a big success at that time. And we did rate it with the covered bond approach, besides the assets were analyzed as SME assets. But then in that case, I think you're just missing out in terms of harmonization. You're just having different players doing different things, and then probably depending on the name and on the standing of the issuer and the reputation, specific reputation from an issuer to another, then you may have very different reactions from the market.
Yeah, also very important to have finally, based on the history of the covered bond, the legislative approach of the instrument, not the contractual, like a structure covered bond. And then for this reason, as Luca said before, we're starting maybe before the other jurisdiction to define the possibility to extend the covered bond concept also for the other asset. But at the same moment, we started the discussion about the harmonization. We stopped the approach in order to clarify better and don't create any confusion also on the European level about this instrument with respect to the covered bond.
Yeah, I think
Steady and trying to access a market in a steady and structured way rather than just creating ad hoc instruments that you can service at the time.
Yeah.
I think Luciano is raising a very important point, which is supervision.
Yes.
I mean, during today we have a lot of opinion about asset class. Well, I don't think that the asset class is the pillar of the covered bond. I think it's more the supervision. I mean, the Danish supervision and the German supervision have done the story of this product. And investors during the crisis, I think, were buying this product because of the mortgages, for sure, but also because there was a clear legal framework and supervision. And we need time because we need to speak with supervisor and they should be ready to make the supervision on this product. You can do a structured covered bond on SME tomorrow morning if you want. But for sure you will not have supervision, you will not have harmonization, as very correctly Federica said. And so we need a bit of time. I think it's important to enter in this directive, that's my personal view, but we need to give time to the European Banking Authority to come out with supervisory best practices, which most probably will be different from covered bonds, yes, because it is a different collateral. Different maybe transparency requirements. Mm-hmm. I can see that with the cash flow model, you should have a different transparency requirement. Yeah. So we need a bit of more time. And we really should have all the stakeholders involved, investors, rating agencies, to be vocal and to work together. And the idea of our ESN task force is exactly this, yeah, to have a large group of people trying to find the right compromise and the right balance at the European level. And yeah, there are still a lot of people very skeptical. It's our job to explain what we are doing and why we are doing so.
Also, my opinion is not to have for the characteristic of the product, the expectation is not overlap with the profile of the covered bond in terms of the maturity, in terms of the rate, because maybe it's floating, is not fixed. Yeah. And then there is also the space to find some investor interested in this specific product because they can cover the specific different investment strategy respect of the covered bond.
So we've only got actually a couple of minutes left. Sort of to summarise, I suppose, I'd like each of you, the Commerzbank deal was a couple of years ago, so the SME funding question seems to have been trundling along for a couple of years now. So if we can start with you, Augustin, to say where you would like to see this debate in a year's time, given that legislation isn't always the fastest moving thing, and how far along the road to confirming a structure you would like to be?
I think that as it has been mentioned here, it would be important that ESNs are at least recognized in the forthcoming covered bond directive, but it's also important not to mess things and to give timing. I can't imagine Spain dealing with such, we have such a huge work ahead to update our covered bond framework. I can't imagine really trying to deal with SMEs at the same time. So I mean, I will be clear about that. So I mean, we need to open the space. We need to open the idea. We need to create the possibility, but as it has mentioned here, it's also very important to define, I mean, what should be the supervisory, even the eligibility criteria. I was personally surprised when the EBA recommendations, they did not pose any ex-ante limits on industrial sectors, or because we know that there are some industrial sectors where NPLs skyrocket in a crisis situation. So I think that that needs to be refined further. So yes, step by step, we in Spain have to deal with a massive work with the update of the current framework and how we do the transition period. We are facing a unique problem among the rest of European jurisdictions that we need to deal with, and it is unclear whether we will have two different types of covered bonds coexisting at the same time, or if we do changes in the law, and it's very, very unclear yet. Where we have this defined, in the meantime, at the same time, we would have the EBA and the Commission working on that purpose, and maybe maybe in 2 years' time, we could be already. When the covered bond discussion has been done and the directive has been transposed, we could be in a better shape to begin this proper implementation of the ESNs. Doing everything, trying to be over-ambitious, I can tell you in Spain will be a recipe of disaster. We can't cope with all the topics we need to.
Federica?
Well, I think, as I said, purely from a rating agency perspective, I don't think we have any concerns in terms of whether we could rate it or not. It's something that we could rate with the criteria that we have in place. In terms of financial structures, it will depend whether, as I said, a bullet, soft bullet, hard bullet, or conditional pass-through structure will be chosen, and also depending on the types of assets, because probably now we talk a lot about conditional pass-through, but probably it won't be a suitable solution for these types of assets. Then it will depend on how the portfolio is what the portfolio is made of. So if you have a very short maturity, it might not be the case for the conditional pass-through to be the best solution, or vice versa. As Luciano was saying, it will depend on the liability side, how the bonds are going to be designed, whether they're going to be fixed rate, floating rate. So it will, I think it's a very open road and a long route before we actually see a standard which is going to be set. So our challenges, as I said, are more on the asset side. So how the performance of the assets is expected to be, how we set our assumptions on those types of assets, which is still very uncertain, and what data we will have available to make our assumptions.
Okay. In a year's time, Luciano, where would you like us to be?
Just a few words. I I don't know exactly which is the right perimeter of the eligibility criteria. We make some work in order to define, because we go deep on the eligibility criteria, maybe it's non-respect of also the characteristic of different jurisdictions. It's very important to maintain the harmonization, but the just right level of the harmonization in order to respect also the characteristics of the jurisdiction.
Okay, so like the covered bond directive that has the domestic changes.
Well, my personal hope is that we have an amendment in the directive opening the door to the ESN, and by September next year we will have, at least in every single Minister of Finance of the Union, a working group analyzing the implementation of the covered bond and studying a potential analysis of what can constitute a framework for ESN. Hopefully this will go back to the European Banking Authority, and then they will propose a framework in the next couple of years, I would say. That's, I think, for me, the most obvious way to move forward. And also there is an opportunity cost. If we are not in this directive, I think it will be very difficult to have this instrument ready and operational in the next 5 years.
Right.
And at that point in time, it could be too late.
Yeah.
And so, I mean, there is also an opportunity cost that we have to factor in this equation, and to say, why not now? We could need this instrument, hopefully not very soon, but I mean, everyone is speaking about the next crisis. Yeah. Madame Nouy of the ECB mentioned this the other day in an interview of Le Figaro. Guy Verhofstadt mentioned this yesterday in his speech in the Parliament. Everyone is expecting the next crisis that could arrive. Today, the Italian Prime Minister is blackmailing to withdraw from this position. We have to be ready, and I think we have done the homeworks. Now it's up to someone else to take our homeworks on board.
Walton?
I think in a year's time, regulators and finance ministries are up to their ears in hopefully implementing a new covered bond directive. Therefore, I would expect the ESN to take a bit of a back seat, or at least hit a bottleneck in a sense from a regulatory point of view. But I would then hope that there would be a box or placeholder or whatever you like to call it in the directive that can just be filled, and then you can have other people working on all the things that we've been talking about, the eligibility criteria, how do we actually set this up, so that we have the, how should I say, the platform building ESN as soon as you get the resources to actually do it. So hopefully that's where we are.
Well, hopefully then we won't drop the ball, so to speak.
Exactly.
And ESNs will be helping fund SMEs as soon as possible. So thank you very much.